Welcome to the Deep Dive. Today we're looking at, well, a really remarkable story. Ireland. I mean, think about it. A country that didn't just get through the recent global storms, but actually came out stronger. We're talking impressive growth, inflation figures that are, frankly, kind of enviable, and public debt coming down significantly. It really is a fascinating case study. Almost seems like they're defying economic gravity sometimes. But when you start to peel back the layers of this latest IMF report, you find this compelling paradox, right? Huge strengths, definitely, but also intertwined with some, well, surprisingly precarious vulnerabilities. So our mission today is to really dive into the 2025 Article 4 consultation report from the IMF on Ireland. We want to pull out the most important insights, the surprising facts, those crucial policy recommendations, basically making you really well informed about this unique economy and, its path forward in what's a very uncertain global environment.
That's exactly right. And for anyone less familiar maybe with these Article 4 consultations, they aren't just a quick check-in. This is the IMF's big annual, really comprehensive economic health assessment for its member countries. Think of it like they're peeling back every single economic layer. Public finances, household spending, the lot. They give you this really granular health report and, importantly, a clear set of prescriptions. And discussions for this specific report, they just wrapped up in early April 2025. The staff report was done in May, board review in June. So this is really timely stuff from the IMF.
Okay, great. So look at the economy's strengths, its recent performance, the key risks the IMF flagged, and that policy roadmap they're suggesting for resilience, plus how the Irish authorities are actually responding to all this. Let's kick off with those strengths, those economic superpowers, as it were. What are the core reasons the IMF highlights for Ireland's, standout success?
Well, the report really points to several key foundational strengths. First off, Ireland's become this absolute magnet for international investors. And this inward investment, it's been an extraordinary engine for growth, really driving up living standards right across the board. And you've got the workforce, highly educated, very skilled. That's crucial. Plus a business environment that, actively fosters innovation. And on top of that, pretty robust policymaking and sound institutional frameworks.
And the numbers in the report really back that up, don't they? I was looking at the per capita modified gross national income, that's GNI. It's just so much higher than the euro area average. Really stands out. And their foreign direct investment per capita, even excluding Luxembourg, which is always an outlier, it's exceptionally high. What's that really telling us compared to their neighbors?
It tells you that even though Ireland's a smaller country, its economic output per person, once you adjust for those big multinational distortions we'll get into, is genuinely world-class. And you couple that with strong governance indicators, things like voice and accountability, government effectiveness, rule of law, they score really well there, and a very high percentage of people with university-level education. It paints this picture of a nation that's sophisticated, highly productive, well-managed, and, a real magnet for top global businesses.
That is a powerful mix. But the IMF makes this really critical distinction, doesn't it, to actually grasp the real size and health of the Irish economy. They don't just use standard GDP. Why is that so important here?
Absolutely crucial. This might be one of the most important things to understand about the Irish economy, and the report really emphasizes it. See, traditional GDP figures for Ireland, they can be incredibly misleading. Massively inflated, really. It's because of the global operations of these huge multinational enterprises, the MNEs. They might be legally domiciled in Ireland for tax reasons, perhaps, but a lot of their activity doesn't actually happen in Ireland or benefit the domestic economy directly. So the IMF uses modified gross national income, or GNI. That's the metric they see as more appropriate. Think of it like GDP is like a funhouse mirror showing this huge distorted image. GNI tries to give you the true size by stripping out those globalized M&E profits that don't stay in Ireland.
Right, filtering out the noise. And then there's modified domestic demand, NDD. That sounds like it drills down even further. How does that help us understand what's actually happening for Irish households and businesses on the ground?
Precisely. MDD is the go-to indicator for domestic economic activity. It's even more specific. Ireland's own Central Statistics Office designed it to strip out really volatile capital investment items. Things like, huge aircraft bought by leasing companies headquartered there, or massive intellectual property purchases by MNEs. These things can be billions on paper, but they don't really reflect day-to-day spending or investment within Ireland itself. So MDD gives you a much clearer, sort of untainted picture of what households and domestic firms are actually spending.
Okay, that distinction is really helpful for seeing the true picture. And looking at that picture for 2024 and into early 2025, the performance seems pretty solid, doesn't it?
It certainly does. that real GNI, grew by an estimated 4% in 2024. That's following a strong 5% in 2023, so still very healthy. And MDD, that measure of domestic activity we just talked about, that increased by 2.7% in 2024, mostly driven by pretty robust private and government consumption. And that was supported by, strong employment figures and good wage growth. Even the standard real GDP, which actually contracted in 2023, bounced back with 1.2% growth in 2024. Net exports played a big part there, particularly pharmaceuticals and electronics. And yeah, the monthly indicators suggest that strong performance carried on into early 2025. Industrial production, services, retail sales, all looking pretty positive.
That growth story sounds incredibly strong. But, for many places, that kind of expansion often brings the headache of rising prices. How did Ireland handle inflation during all this? Did they manage to buck that global trend too?
They absolutely did. Ireland's performance on inflation is really quite remarkable. Headline inflation dropped significantly. It ended 2024 at just 1%, bringing the average for the year down to 1.3%. That made it among the very lowest in the entire euro area. Really quite something. Now, it did tick up a tiny bit in early 2025, mainly because the drag from falling energy prices faded away, but it still stayed below 2%. Core inflation stripping out energy and food that's hovered around 2% since the start of 2025. Although, services inflation was a bit more stubborn, running above 3% on average, but overall, a very strong performance on inflation control.
And a tight labor market must have helped fuel some of that domestic demand we were talking about.
It certainly did. Employment grew at pretty healthy rates. Immigration helped, but also higher labor participation, especially among women, which is a positive sign. The unemployment rate was down at 4.3% in 2024. That's very close to historic lows for Ireland. Now, there are signs labor demand might be cooling off a bit. Job postings were down compared to the year before, but vacancy rates are still pretty high in certain skilled sectors. Think professional, scientific, technical jobs. That suggests some ongoing shortages there. And crucially for households, nominal hourly wages grew by 5.4% in 2024. That meant real growth wages after inflation finally turned positive after 2 pretty tough years of decline. That's a big deal for people's spending power.
Okay, so beyond the growth, one of the really interesting parts of the report is Ireland's public finances. It shows this big surplus, but it also points to a kind of hidden vulnerability, right?
It certainly does. On the surface, things look great. Both government revenues and spending grew strongly in 2024. And the result was a sizable general government surplus, estimated at a pretty remarkable 7.5% of GNI. That's very substantial. Public debt also kept falling, down to 70% of GNI in 2024. But, and this is the really interesting bit you flagged.
Yeah, here's where it gets really interesting.
Exactly. There was a significant one-off boost to revenue in 2024, an extra $14 billion. That's about 4.5% of GNI. And it came from a recent ruling by the European Court of Justice concerning Apple.
Wow, $14 billion from Apple. That sounds like a massive win just on the face of it. But is there a catch? Is there a vulnerability hidden in such a huge one-off payment, especially from just one company? How does the IMF see this? Is it a net positive or more like a warning sign?
Look, that $14 billion windfall, it's definitely grabbed headlines, but it's actually more like a flashing red light on Ireland's economic dashboard, because it really exposes this stark reliance, this dependence on just a handful of massive corporations for the public finances. The IMF strongly stresses this concentration of corporate income tax receipts. It comes from a tiny number of multinational firms and only in a few key sectors. We're talking ICT manufacturing and services, holding companies, aircraft leasing, pharma manufacturing, that's pretty much it. So the real insight here isn't just the $14 billion itself, but the huge concentration risk it highlights. In fact, the IMF estimates these so-called windfall corporate tax revenues, the bit that's sort of above and beyond what you'd normally expect, will average a staggering $16 billion every year from 2025 to 2030. That's a massive chunk of national revenue hanging on a very narrow and potentially volatile base.
$16 billion a year, potentially. That is a huge reliance. Okay, so stepping back a bit, how's the broader financial system coping? And what about real estate amidst all this activity?
Well, bank lending growth has picked up a bit, mainly driven by housing loans and consumer credit, up about 3% year on year recently. Interestingly, lending rates for businesses went up the most when the ECB was tightening, but rates for consumer loans barely budged, although rates across the board have started trending down lately. The banks themselves, the IMF considers them generally sound. They've got strong capital buffers, good liquidity, and profitability has improved. Non-performing loans are down too. However, and it's an important however, the IMF does point to pockets of vulnerability. particularly their exposure to the commercial real estate sector, the CRE market.
Right, commercial real estate. And speaking of property, I saw residential prices kept climbing. Is the housing crisis still very much a major issue then?
Oh, absolutely. Residential property prices just kept going up. They actually accelerated to 10% year-over-year growth in August 2024 before easing back slightly to 8% by February 2025. And the main driver is still persistent undersupply. Not enough homes being built. But it's a totally different story in commercial real estate. That downturn is ongoing. Capital values for offices and retail spaces are falling. Office vacancies are up significantly. Demand seems pretty low. And overall, CRE rents are basically flat. So yeah, you've got these two completely different narratives playing out within the property sector.
Okay, so bringing this all together, looking ahead, given these unique strengths and, well, these vulnerabilities, what's the IMF's forecast for Ireland? And what are the really big risks that you see looming?
The outlook is for continued growth in the domestic economy, but definitely at a slower, more moderate pace. That's mainly down to the highly uncertain global picture. They project real GNI to increase by about 2.4% in 2025, then maybe a bit less in the couple of years after that. Eventually, they see it settling around its potential growth rate, which they estimate at about 2.25% in the medium term, inflation. Both headline and core are expected to stay pretty close to that 2% target from 2025 onwards.
Okay, slower but steady growth. But the risks? It sounds like there's quite a shadow of uncertainty hanging over even that moderate forecast.
There really is. The IMF flags some substantial downside risks. Number one, and we keep coming back to this, is that concentration issue. The heavy reliance on a small number of MNEs makes the economy and the government's finances highly vulnerable to shocks, shifts in global trade policy, changes in international tax rules, or even just problems at one or two specific big firms or sectors. Second, this idea of globalization in reverse. If trade tensions escalate, if we see more tariffs on key sectors Ireland relies on, that would hit exports hard, drag down growth, push up unemployment. It fundamentally threatens the Irish economic model, which has thrived on free trade and capital flows. You could see supply chains reorganized, companies moving intangible assets elsewhere, less investment coming in. Then there's geopolitics. More intense regional conflicts could disrupt trade further, maybe lead to more refugee inflows, cause commodity prices to spike again. And finally, there are domestic risks too. Supply-side bottlenecks, especially in housing and infrastructure. If those aren't tackled, it could delay national goals, push up costs. And while the risk of the economy overheating seems less pronounced than maybe a year ago, it's still there. Especially if fiscal policy becomes too loose while the ECB is potentially easing monetary policy.
And the Irish authorities themselves, do they generally see eye to eye with the IMF on these risks? Or do they perhaps have a slightly different take on the path ahead?
By and large, they concur. The report says the Irish authorities broadly share the IMF's views on the outlook and the main risks. They definitely acknowledge Ireland's vulnerability to global uncertainty and trade tensions. You can't really ignore it. But they also, quite rightly, highlight the economy's proven resilience. I mean, it's weather Brexit, the pandemic, consecutive large shocks. So they point to that track record. And they explicitly agree that those persistent gaps in infrastructure and housing are now becoming a real drag on the country's competitiveness. So yes, broad agreement, but maybe with a bit more emphasis on their past ability to cope with shocks.
Okay, let's pivot then to the IMF's RGA for resilience, as you called it, their policy prescriptions. What are they recommending on the fiscal policy front, especially given those big surpluses we talked about?
Right. On fiscal policy, the IMF recommends what they call a broadly neutral stance for 2025 and into the medium term. But, and this is key, with higher capital expenditure, their thinking is the economy is already running at pretty much full capacity. So fiscal policy shouldn't be adding extra fuel to the fire, especially if monetary policy is easing. A neutral stance avoids adding to aggregate demand. But Ireland desperately needs to ramp up public investment to fix those housing and infrastructure deficits. So the plan to scale up capital spending is good, but it needs to be done smartly, within an appropriate overall spending limit, ensuring value for money. And that they really stress the need to speed up the planning and judicial review processes. Those are seen as major bottlenecks holding back essential projects. Interestingly, they note Ireland is quite efficient in education spending, but see room for improvement in getting more bang for the buck in health spending.
So invest more, but invest smarter. Makes sense. But what about that elephant in the room, the huge reliance on corporate tax from just a few players? That concentration risks sounds like it needs urgent attention.
Absolutely. And the IMF addresses it directly. It's a critical recommendation. Given that high concentration and, frankly, the uncertainty around those MNE corporate tax revenues, they say Ireland needs to actively broaden its tax base. Make it more resilient. How? Well, they suggest several potential avenues. Reforms to VAT, value-added tax, for instance, maybe reducing the number of items that get preferential lower rates, as those often tend to benefit higher income earners more anyway. They also talk about property tax, potentially increasing taxes on residential property and land, and even looking at personal income tax, maybe introducing additional tax bands to make it more progressive or generate more revenue. Beyond specific taxes, the IMF strongly recommends strengthening Ireland's national fiscal framework, ideally putting it into law. This would help safeguard public finances against future shocks and manage those long-term spending pressures like aging population costs. What might that look like? Well, maybe a clear debt anchor. They suggest targeting a net debt to GNI ratio of, say, 40%, and complementing that with an operational rule based on multi-year ceilings for net government expenditure. That gives more predictability. And crucially, integrating those two new savings funds, the Future Ireland Fund for long-term needs and the Infrastructure, Climate and Nature Fund for counter-cyclical spending, fully into this stronger framework.
Okay, a more robust fiscal house. What about financial stability? In this shifting global picture, where are the main vulnerabilities the IMF is watching?
Well, even though Irish households and businesses generally have healthy balance sheets right now, the IMF warns that increased global uncertainty could interact badly with existing financial vulnerabilities, particularly things like liquidity mismatches where assets can't be sold quickly enough to meet liabilities, and the leverage, the borrowing within the investment fund sector, the non-bank part of the system. These could amplify any negative shocks that hit. Now, the Irish banks themselves, as we said, they remain sound. Good capital, good liquidity, better profits. But the IMF stresses the need for continued close monitoring, watching credit quality, liquidity risk, operational risks, especially given those exposures to the struggling commercial real estate sector. Then there's the non-bank financial frontier. This is a huge area for Ireland, regulating investment funds, market-based finance. The Central Bank of Ireland, CBI, has actually made considerable progress here. They've stepped up monitoring, and they're even seen as international leaders in developing macroprudential tools for non-banks. For example, they worked with Luxembourg on rules for certain types of LDI funds. However, the IMF says there's still work to do. They need to keep strengthening reporting requirements for these non-bank institutions, do more detailed risk analysis, and crucially, address persistent data gaps, especially concerning what they call other financial institutions' residual entities. These are basically the less visible, harder to categorize parts of the financial sector. And data gaps there could hide significant risks, making it tough for regulators to see the full picture.
Right, the known unknowns almost.
Right.
Okay, beyond the fiscal and financial stability, what about structural reforms? What's the IMF suggest for boosting Ireland's long-term competitiveness and, overall well-being?
Well, given that risk of geoeconomic fragmentation, the world splitting into blocks, they say Ireland needs policies to strengthen its resilience. One key recommendation is promoting closer links between those dynamic multinational companies and domestic Irish firms, especially in innovation. They give the example of the Tyndall National Institute, which helps foster collaboration between global tech giants and local SMEs in areas like semiconductors. More of that kind of thing. Also, obviously, improving infrastructure is key. And continuing to engage actively within the EU to further strengthen the single market is also vital for an open economy like Ireland.
And thinking about the future, what about new technologies? Things like artificial intelligence, digitalization. Ireland seems pretty advanced there already, doesn't it?
It really is. Quite remarkably so, actually. The IMF notes Ireland is very well positioned to benefit from AI and digitalization. Why? Well, they have a strong focus on STEM, education science, tech, engineering, math. There's robust collaboration between universities and businesses, including those innovative large MNEs, and they host one of Europe's biggest clusters of data centers. The report mentions a survey where over 90% of organizations in Ireland said they were using AI in 2024. That's a massive jump from about half the year before, so adoption is happening fast.
90% using AI. So bringing that all together, what's the big picture implication of this rapid AI adoption for Ireland's workforce, for its economy? Is it all upside?
Well, not entirely. While AI is clearly a potentially powerful engine for growth, the IMF does raise some important cautions. One is uneven adoption. Smaller and medium-sized businesses, the SMEs, often struggle with the costs and maybe lack the capacity to really leverage AI effectively compared to the big players. And more critically, perhaps, the IMF's own analysis suggests that around 30% of employment in Ireland is in occupations that are at high risk of AI substituting for human labor. So that calls for some pretty proactive policies, making sure AI adoption is equitable, providing targeted support for those microenterprises and SMEs, and crucially, thinking about adjustments to the tax and welfare systems to cope with potential disruption. Plus, of course, investing heavily in education and training programs to help the workforce adapt and reskill for an AI-driven future.
Okay, that's a huge challenge. And finally, let's circle back to that persistent housing crisis. What's the IMF's specific advice on tackling this really critical domestic issue?
Yes, it remains absolutely critical, and the picture is mixed. After picking up in 2023, the actual number of new homes completed dropped in 2024. That's despite the number of projects starting actually increasing. And the decline was mainly driven by fewer apartments being finished. The IMF suggests this likely reflects investors becoming less interested in the rental market, possibly due to the tight rent controls currently in place. Affordability is still a massive challenge, and housing supply just desperately needs to expand faster. So, what does the IMF recommend? Increasing urban density building up, not just out, boosting productivity in the construction sector itself, improving how land is used. They also stress the need for greater certainty around housing policy to encourage investment. And again, speeding up that complex planning process is vital. Leveraging private capital more effectively and maybe converting vacant office spaces into homes where it makes sense are also suggested. And then there's a slightly provocative point. The IMF suggests that rental supply could actually be increased by, and I quote loosely here, reducing the complexity and restrictiveness of rent legislation. Specifically, they float the idea of replacing broad rent caps with more targeted housing support aimed directly at vulnerable households. That's bound to be a contentious suggestion, of course.
Yeah, that's definitely a hot topic. So, okay, we've heard the IMF's detailed diagnosis and prescriptions. How are the Irish authorities actually responding to all this? Is it mostly agreement, or are there points where they push back?
Overall, it sounds like broad agreement. The report indicates the authorities largely concur with the IMF's assessment and the general direction of the policy advice. They definitely emphasize Ireland's resilience, its strong fundamentals, while fully acknowledging those big external threats like trade wars and geoeconomic fragmentation. On fiscal policy, they're committed to prudence. They're actively updating the National Development Plan to ramp up that public investment we discussed. They do recognize the need to broaden the tax base eventually, but they also note, perhaps understandably, the practical difficulty of raising other taxes right now when the country is recording these huge surpluses thanks to those windfall corporate tax revenues. It's a politically tricky sell. They're very supportive of the strategic role for those two new savings funds, seeing them as key tools for managing the windfall and future needs. One slight nuance: they apparently express a preference for an expenditure-based fiscal anchor, like that spending ceiling rule, rather than a debt-based one. They feel it's easier to communicate and maybe better suited to Ireland's current favorable debt situation.
Okay, and on the crucial issues of housing and competitiveness, are they moving with the kind of urgency the IMF seems to be suggesting?
It appears so. They're actively updating the Housing for All plan, extending it out to 2040. They're implementing that new Planning and Development Act. It was signed into law last year, though its full effects probably won't be felt until 2026. And they're revising the National Planning Framework, all with the aim of speeding up housing delivery. They acknowledge the challenges, though, things like not enough capacity in the construction sector and those infrastructure deficiencies holding things back. A review of the current rent regulations is apparently nearing completion, and a whole new national housing plan is expected later this year. So, lots happen on that front. They're also preparing a new action plan specifically on competitiveness and productivity, which will address risks and propose resilience measures. And very much in line with the IMF's points on AI, they've recently updated Ireland's national AI strategy to try and leverage its potential while making sure it's done in a people-centered, ethical way.
Right. So to kind of wrap up this deep dive then, Ireland has shown genuinely impressive economic performance. It's built on really strong foundations, some smart policy choices over the years. But as this IMF report makes crystal clear, it's also an economy facing some pretty significant external vulnerabilities and absolutely critical domestic challenges, especially housing. The IMF offers a fairly clear roadmap here for building greater resilience, for ensuring that growth is sustainable and inclusive going forward, which I suppose leads us to a really crucial question, something for you to think about. For a small, very open economy like Ireland, so deeply plugged into the global system, how does it keep navigating what seems to be an increasingly fragmented and uncertain world? How does it do that while simultaneously tackling these huge domestic issues like housing affordability and ensuring that powerful new technologies like AI benefit everyone equitably? What lessons, perhaps, can you draw from watching Ireland perform this intricate balancing act, juggling global engagement with pressing local needs as it really strives to secure its future prosperity?